Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey, everyone. So Bill Ackman out today calling out these triple levered ETFs, levered ETFs in general, and the zero-day options boom, really kind of questioning things on a number of fronts. Number one, criticism of people getting into high-risk type investments. Okay. That could be destabilizing. I'll show you in a moment how that actually works. I'm not sure he really touches upon some of the mechanics of how these things work. Number two, leverage ETFs market impact. So the impact on a theme basically falling out of favor and assets really getting crushed. You look at something like MSTX down at one point maybe 90% versus MSTR. You can see how a lot of money can be lost there. Zero-day option concerns, are there just a lot of people out there kind of gambling? Is that an issue? And so really kind of wondering if, particularly in a difficult market, if this is the place for people to be. So in terms of the mechanics of this, we can see here, I talked about the actual math behind this in this video. I'm going to link down below to that video, how I knew we would close high. But basically, it talks about the math. I'm not going to do it again behind it. So you can kind of see here, the orange is the triple levered version of the blue. So the blue is the market kind of moving up and down, up and down. The orange starts from the same place, outperforms the blue to the upside, outperforms, I guess, to the negative, to the downside, outperforms to the upside, outperforms to the downside. And so when you have a lot of this up and down movement, look at where they get to. Well, the orange has actually lost money versus the blue, even though this product, the blue, has gotten right back to where it basically kind of started, right? So almost where it started, and this thing has lost quite a bit. So this is the issue. There's a mathematical impact to this leverage rebalancing that is a kind of decay that doesn't come back. Right, that's really the big problem behind here, and I think many people don't realize that. He's not really talking about that, but this is something I think you should be aware of. And is it a big impact to markets? Well, yeah. Look at where these ETFs are positioned: the 2-time, the 3-time. They are mostly in the areas that have quite a bit more volatility, where there has been excitement around themes, around AI, around Bitcoin, and things like that. You can see Mag 7, technology, semiconductors. This is where the lion's share of these products actually reside. And you can see here how they've grown over the last few years, particularly since 2020, as we've seen option volumes expand. We've seen interest in these products expand. They have come down a little bit. This is from a little while ago, so they've come down even more in this recent downturn. So we're seeing AUM disappear a little bit because of the impact that sell-offs in these thematic areas and Mag 7 have had. But it's important to know that this is really, it's sort of captured the zeitgeist of what's going on out there, of people's desire to really take part in these very formally strong themes. They may come back, but at the moment they've really been struggling. So we can see the impact, which I go through the math of in the other video, which is basically that you can exacerbate moves to the upside, to the downside. We call this synthetic gamma. So because of the rebalancing that is required on an up day versus down day, and how that gets magnified on a strong up day versus strong down day, this is what you can get. So this is sort of the different Mag 7 stocks. And depending on how much the stock moves, right, 3%, 5%, 10%, we saw a day like this the other day, we were over 20% in each of these names. This was the biggest rebalance we've ever seen in the history of these products. So these products have sucked in a lot of money, and they are actually starting to move markets around. And that's why I said I figured we close on the highs of the day, which we did. Almost the absolute high tick on the day, which I called around 2 p.m. that day, saying, listen, these are too powerful, and to the upside, they're going to really push things. So here are the rebalance projections on a very big day. These are going to vary depending on how much things are moving around. But this is very big business now, and it's actually impactful to markets. The other thing that he's talking about is zero-day options. So it's a thing. It's a big thing, in fact, right? So we've seen zero-day becoming well over 50% of volumes out there in terms of option volumes, broadly speaking. So we have people really positioning themselves. Are they using zero-day in sort of responsible ways to hedge and get through specific events, short spans of time where there may be an event of some kind, a meeting, a number, data of some kind? versus the old days where you basically just have to position yourself in mostly a 1 month, maybe, maybe if you're lucky, a weekly in S&P or something like that. But now these things exist every single day. So are people sort of moving away from the more traditional, longer tenor, we call it, longer expiry hedges and viewpoints, right? The ways to express their views to something more 0 day. Well, it certainly looks like it, but I would certainly wager a guess that there's a lot of speculation happening in there. So his concern is that maybe this is all part of a broader kind of worry that we should have related to how much sort of very, very short-term thinking is this really investing, right? That's the big question he's having here. If we're looking at 2-3 time ETFs, we're looking at 0DTE options. Is this investing anymore, or has this become more or less a big casino? Well, you can have a guess at that yourself. I think it's clear that this has become very, very popular, particularly since 2020, when people sort of sat at home, didn't have much to do, couldn't bet on sports, couldn't go to the movies, couldn't go to theaters, and they basically started to get excited about trading markets. So I think there's probably some truth to that. I think there's certainly some benefit to having some of these things to hedge yourself. But the problem is, what a lot of people don't realize is that these products really can get chopped up, right? So some people will put these levered products in their accounts for long periods of time. Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video. So I want to show you a real-time example of this. So let's take the 𝐸-𝐸𝐿, which is the 3-time bull semiconductor index product that's an ETF that's put out by Direction. And you've got the SOX, right? The semiconductor index, which is not a levered product. So we can see they both start out at the same level, basically going back 1 year at this point. And we can see that the SOXL outperforms, as it should, right? It should give you 3 times the daily performance, but they're only promising you that daily performance, right? That's their best efforts basis to give you 1 day performance. But what happens when you have a strong move is they have to buy a whole bunch of the underlying exposure. And if you turn around, now they're overexposed. So on a down day, they actually have to sell out some of that exposure. Well, what does that mean? They're getting chopped up a little bit in high volatility markets. So when I say that, that means realized volatility is high. Right? When realized volatility is low, let's say this product is just going straight up. If the underlying index is just going straight up, this is going to work very well for you. But when you get into an environment where there is high realized volatility, you have to understand that you are short realized volatility. What do I mean by that? When you are short something, that means when it happens, it hurts you. So when you are short realized volatility, you are not benefiting from things becoming more volatile. You want them to be less volatile. So your short realized volatility when you own something like 𝐸-𝐸𝐿, I've talked about these products since last August, September. So and repeatedly on X, I've been talking about it. Please be careful. These are very dangerous products, but of course people will just do it. And so you can see here, it outperforms. Then when the SMH, the SOX comes down, it underperforms, right? So it kind of flies right by the performance. So it's basically underperforming the index. Then as the SOX comes back, it outperforms, et cetera, et cetera, et cetera. Well, what do we have here in the end? We have the SOX down 10%, and we have the SOXL down 70%. Now, this is 1 year. If you use different periods, it may not look as bad. It may look worse. So I don't want to say this is always the kind of performance that you're going to get, that sort of 10 to 1 to 7 ratio. Absolutely not. But this just happens to be the performance going back 1 year, back to about April 14th. So this is basically what you're facing. So if you want to own these things for periods where when realized volatility is low, I think that can make a little bit more sense. And by definition, when realized volatility is low, it's when the underlying index is just kind of probably either going sideways, but in all likelihood is probably rising slowly and steadily and not having those sort of 1 day up, 1 day down, 1 day up, 1 day down. Could be 3 days up, a little bit of a day down, et cetera, et cetera. So 3 steps forward, 1 step back, but in a very kind of consistent way, it's gaining, and that's going to benefit something like this. When it's very, very choppy, this is what you end up with. And that's the danger in holding something like this for a long time. As I said earlier in the video, these decay losses, these leverage decay losses, are some of it is permanent. So what happens at this point is it's difficult for this 𝐾𝐧'𝐭 to get back up to where it was before because some of this is permanent. You can almost think of it as almost like options decay. Once it's gone, it's gone. It's not impossible for this to do well again. Absolutely not. It could do well again if the semiconductor index starts to perform well. But the fact remains that it is sort of behind the eight ball a little bit, and it's going to have to work very, very hard to start doing well again. And I think the best way to trade these things, I'll do another video on it, is when realized volatility drops below a certain point. So hopefully that helps everybody out there. I think Bill Ackman's right. I'm not sure he sort of understands all of the mechanics of this underneath the surface, but he's absolutely right. There are risks to this, and I'm glad he's highlighting that. See you in the next video.